Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance, sometimes with a smirk and a knowing glance at the numbers. Today we're diving deep into KKR Real Estate Finance Trust Incorporated, or CREF's latest quarterly report. Think of it as a detailed check. Up for a company that deals with a lot of money tied up in buildings and loans. If you appreciate getting straight insights into these complex financial documents, make sure you are subscribed and join our Discord community, linked in the description below, where we break down more filings like this. So what is the big news? Well, CREF released their report for the quarter ending the 30th of September 2025. And while it might seem like just another set of numbers, there is a story here about how they're navigating financial markets in the real estate world. We'll look at their income, expenses, and most importantly, their huge portfolio of loans and properties. Let's start with what they actually own and what they owe. As of the 30th of September 2025, CREF had about $6.4 billion in assets. That sounds like a lot, and it is. What is interesting is how much of that is considered cash and cash equivalents, about $204 million. That is a healthy amount to keep things running smoothly. Then there are their commercial real estate loans held for investment, which make up the biggest chunk of their assets, over $5.1 billion. But remember, they've subtracted an allowance of $157 million for potential loan losses. This allowance is their way of saying, hey, we know some loans might not get fully paid back and they're setting aside money just in case. This $5.1 billion in net loans is the core of their business. It is essentially money they've lent out secured by commercial properties. How are these loans doing? Well, their total net interest income for the 3 months ended the 30th of September 2025 was about $25 million, a decrease from the previous quarter. This dip is partly due to some loans being on what they call non-accrual status, which means payments are not being made on time. Now let's look at their income statement for a broader picture. For the 9 months ended the 30th of September 2025, their total net interest income was around $86 million, down from $116 million a year earlier. This drop is significant and reflects the challenges in the lending market and perhaps less portfolio activity. The decrease in net interest income is mainly because interest income went down by over $100 million year over year. Their interest expense also dropped, but not as much, leading to that lower net amount. This suggests that either fewer loans are outstanding or the rates on those loans are lower on average compared to last year. Looking at the detailed breakdown within the income statement, we see that revenue from real estate owned operations also took a hit, decreasing by over $7 million compared to the same period last year. Even their income from equity method investments, which represents their share in other companies, went from a positive $1.6 million last year to a loss of almost $1 million this year. This indicates a tougher market for their real estate holdings and investments. One of the most critical line items here is the provision for credit losses. For the 9 months ended the 30th of September 2025, this was about $75 million, very similar to last year, but it had a significant impact on their overall income. In fact, in the second quarter of 2025, they had a provision of almost $50 million, which really pulled down their net income for that period, causing a loss per common share of 53 cents. Operating expenses as a whole remained relatively stable year over year, around $126 million for the 9-month period. This indicates that while their core lending income has decreased, their expenses haven't grown proportionally, which is good news for managing costs. When you put it all together, for the 9 months ended the 30th of September 2025, CREF reported a net loss attributable to common stockholders of nearly $38 million. This is a stark contrast to a small loss of just $1.5 million in the prior year. The net income per share for this period was a negative 56 cents. It is also worth noting that the number of average shares outstanding has slightly decreased year over year. This could be due to their share repurchase program, which is designed to buy back company stock, potentially increasing the value of remaining shares. Now let's talk about their book value per share, which represents the net asset value per share if the company were to be liquidated. As of the 30th of September 2025, it was $13.78, down from $14.78, down from $14.76 at the end of 2024. This decrease is largely due to the losses incurred during the year and the impact of credit loss provisions. Importantly, their book value calculation includes a significant allowance for credit losses of about $160 million, which works out to almost $2.45 per share. This provision is a direct hit to book value and shows the company is being conservative about potential future loan losses, which is wise. Let's look at their debt situation. Their debt to equity ratio as of the 30th of September 2025 was 1.8 times, which means they owe $1.8 for every dollar of equity they have. This is up from 1.6 times at the end of 2024. This increase in leverage, while not alarming, suggests they've taken on more debt relative to their equity, likely to fund new investments or manage operations. Their total leverage ratio remains steady at 3.6 times, indicating a consistent level of overall debt relative to their equity base. When it comes to liquidity, KKR has about $204 million in cash and cash equivalents. They also have a very substantial $700 million revolving credit line available, which is a great safety net. On top of that, they have almost $29 million in other available borrowings under different financing agreements. This gives them a total of over $933 million in readily available funds. This is crucial for a company like this where loans can be long-term, and there can be unexpected needs for cash. Looking at their future obligations, we see a very large number of commitments over $6 billion. This mainly consists of their secured financing agreements like repurchase facilities and term loans that need to be paid back. A significant portion of this is due in the next 3 to 5 years, and then a large chunk is due beyond 5 years, which is typical for real estate related financing. They also have over $426 million in future funding obligations, meaning they've committed to lending more money on existing loans, a common practice in construction and development financing. Now for the part where they tell us all the ways things could go wrong, and there are quite a few. They highlight risks like general economic conditions, inflation, and rising interest rates. They specifically mention that lower demand for office space and hybrid work schedules could negatively impact properties that secure their loan. They are also exposed to credit risk, meaning borrowers might default in interest rate fluctuations, which can affect their income and the value of their investments. Conflicts with their manager, KKR, and its affiliates are also listed as a risk, which is always something to watch for when a company outsources its management. So what is the takeaway here? Well, KKR is in a tough spot. Their core lending business saw a significant drop in net interest income and a substantial net loss for the first 9 months of the year. The increase in their allowance for credit losses and the decrease in book value per share are clear indicators of the financial pressure they are under. The real estate market, especially for office properties, is facing headwinds, and this directly impacts KKR's portfolio. While they have a healthy amount of cash and a large revolving credit line, and their leverage has increased, which is a concern. The decrease in book value per share from $14.76 to $13.78 is a red flag showing their equity is shrinking. The swing from a small loss to a much larger loss in net income attributable to common stockholders year over year is concerning. They are clearly feeling the impact of higher interest rates and a challenging real estate market, which is leading to more loan losses and a decrease in overall profitability. However, the company does seem to be managing its expenses reasonably well and actively managing its loan portfolio. The provision for credit losses remains high, which signals they are being prudent in anticipating potential defaults. Looking ahead, KKR is navigating a challenging economic and real estate environment. Their strategy of originating senior loans is sound, but the current market conditions are putting pressure on their profitability and asset values. The key will be how effectively they manage their existing loan book, and if they can originate new loans at favorable terms without taking on excessive risk. Their large credit loss provisions suggest they are aware of the risks, but the increasing leverage and declining book value are points of caution. We'll be watching to see if the interest rate environment shifts favorably and if the real estate market stabilizes. Alright, that is our breakdown of KKR's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.